So a machine will cost $800,000, okay, and last for 5 years. After which it will be sold for 5% of its initial price. Cool. Then what else is mentioned? 5% of its initial price. Additional working capital of 90,000 will be required at the start of the first year of the operation. Okay. Now production and sales from the machine will be 100,000 units per year. Each unit can be sold for $16. Will incur variable costs of $11. Incremental fixed cost will be $160,000 per year. Now, company uses an after-tax cost of capital, so post-tax 11%. Base profit tax 1 year at annual rate of 30% per year. Capital allowances and inflation should be ignored. Okay, so this is not an inflation-based question. It's actually a very easy question. For you guys now, this is just a revision of what we just did earlier in the last chapter. I think the only real thing is calculating what the sales value would be and all of that. And there is, of course, working capital to be calculated. So let me take you guys to an Excel sheet and we can figure it out there. Any questions that you guys may have with regards to the question itself?
No.
Okay, then we can go to the Excel sheet. Here we go, guys. I hope you can see it. Yeah. We'll just zoom out and fix this issue. 1 second. Oh my God. Now, if you guys can see my screen, there we go. Tell me, what are the cash flows? Year 0. What analysis of the question did you do? Year 0, what is the cash flow, guys? Nothing, is it?
Working capital.
100 units. Year 0 would be nothing.
Yeah, initial investment. Usually we mention this later, but
800.
800,000. Okay. Then what else? Can we put a scrap value here? I think we do get a scrap value, right? Usually when we take initial
5%.
investment. Yes. You remember to put in the scrap value. By the way, which year are we getting the scrap value? How many years is this? 5 years.
Last for 5 years.
So then it will be in the 5th year. Can I say? 5th year or 6th year when we get the scrap value?
After 5 years, it will be year 6.
After 5 years, which means end of the 5th year. Can I say that?
Yeah.
And we always assume all the cash flows for a year happening at the end of the year, correct?
Yeah.
So then there you go, year 5 only. Okay. Now, I mentioned year 6 because taxes in arrears. That is right. Now, okay, we will have to calculate cash flows, guys. What are the cash flows here? Every year there is sales. Okay, separately I'm going to mention this so that we only need to take the main values to the table. Sales is 100,000 units, correct? At $16 selling price. Is that right?
Yeah.
And variable cost is effectively 100K
11.
multiplied by $11.
11.
Which means you guys know the idea of contribution.
$5 per unit.
Yeah, contribution is $5 per unit, which means effectively 500K. Is that right?
500,000. Yeah.
But one more thing we can take into account. Incremental fixed cost means relevant or not relevant. Is that a real cash flow or not a real cash flow? Relevant or irrelevant?
It's not irrelevant. No, it's incremental, right?
Correct. Yeah. If it was simply fixed cost, not relevant. Why? It's already committed cost. Yeah. Incremental means because of this project, we are going to incur it. Purvi?
Yes.
Yeah.
Right. You also got this. Okay. Rajiv, wonderful. Yes, both of you got it. Then can I take the 160K out? So can I say every year it's roughly 340,000?
340,000.
Yeah.
Because no other inflation, nothing is mentioned, which means every year, our cash flow, right? Cash flow will be 340. So I'm going to put that in for the 5 years. 340. Cool. All good. Yeah. Then taxes based on these cash flows. What will the tax be? Tax is paid at 30% and it's paid 1 year in arrears, which means in year 0, no taxes. Year 1 also no tax. Year 2, there will be a tax based on
102. 340.
Based on 340. Yeah. And tax will be an outflow. Is that right?
30%.
Negative numbers.
Minus.
Right. Now I'm putting that down here. And tax will last till year 6. You guys may agree. Correct?
Yeah.
Arrears. Yeah. Now tax benefit is also there. Where am I pulling that out of? How? Tax allowable depreciation, it's a machine, no? What do you guys think? What depreciation is mentioned? Or no capital allowance, guys. No capital allowance. No capital allowance means, do I need to take tax benefit?
No, then you won't take it.
Yeah, in a bigger question, this will be there. Okay, here in this question, to make it convenient, they have mentioned clearly no capital allowance, no inflation. So the only challenging thing will be working capital. Is there working capital? Additional working capital of 90,000 will be
Additional
required.
90, start of the first year.
Start of first
year
year.
one.
Start of first year means when is that additional working capital coming in?
End of
Year 0.
Year 0 only, correct. Yeah. So working capital WC, right, will come up in year 0 only. And when will I get it back, guys?
Year 5.
End of year 5.
Year 5. Yeah. Net effect, that line will be a sum of 0. Why? Whatever money you put in, you get it back. Now, okay, that is that. Then what else? Anything else I should take into account? I think that's everything, right? Can I go for the net cash flows?
Yes.
Net cash flow should always be your last line. Okay. After that, it's all about discounting then, right? So let's go. Oh, what did I just press? Okay. Okay. What do I get? Take a sum of all of this. Now I copy that formula here, and finally here. Is that right, guys? What do you think? Net cash flows? Anything I've missed out? We took our working capital back. We took the benefit of tax. Well, not the benefit of tax. We took the tax, no benefit to be taken. And we took cash flows also. Okay, cool. Now, discount factors, what percentage are we talking about? 11%. Is that right?
10%, yeah.
11%. To make it easy, I'll give you guys the discount factors. But do tell me, what is year 0's discount factor?
1.
You guys should tell me that immediately. Yeah. Year 0 means 1. Today's value is today's value.
Yeah.
Right. 0.901. Yeah. I'm just copying this off here. 0.901. 0.812. Okay. 0.731. Okay. 0.659. All right. Then what else do we need? 0.593.
535.
535. Wonderful. Wonderful. Yes. 535. Now tell me. Okay. Can we find out discounted cash flow? 890 into 1. Okay. For the first case. Then paste it everywhere. Hey. My bad, guys. My keyboard is the worst keyboard, as you guys can probably tell. Yeah. Oh, what the? Please ignore that. Right. My keyboard's control key doesn't even work. Anyway, copying this and putting it here, and here. There you go. Now, what's next? Present value, NPV. NPV is simply a sum of all of this. If you guys want to show it in writing, of course, you can show off the present value of investment phase minus present value of the present value of the returns, of course. Yeah. So there you go. 104.57. Is this a project you would go ahead with or not? What do you guys think? Yeah. Purvi, what do you think? 104.57. All right. Now they have asked us for NPV and they've also asked us for IRR. How will we find IRR? Can we find a new discounted cash flow at a different rate of interest?
Yes.
Maybe 15%.
15%. Yeah.
Why am I going higher, Rajiv?
Because it's positive, so as we go higher, it will be negative.
Exactly. And interpolation. We want both ends of the spectrum.
Yeah.
I don't want two positive values. I can, but it's not recommended. Right. Now, then tell me, what was 15% numbers? I remember we used it for the last question, but what was it? Do you guys remember?
0.870.
Wonderful. Yes, Purvi, 1 second. 0.870, correct? Then
0.756.
756, then
658.
658, cool. Then
572.
572, okay. Then
497.
sorry,
497.
497, okay, cool. Last one,
432.
432. All right, wonderful. Now we can find out a new discounted cash flow again. Same formulas, all of that, right? So remember to take the actual net cash flow, not the discounted cash flow from previously. multiplied by this. Okay, now paste the formula all over here. Yeah, there you go. Right. Now, can I find NPV at what is this? 15%. Sum of again all the values till here. There you go. 17. Hey, 17.3 at 15%. What have we got? Have we got a negative number or a positive number?
Positive.
Okay, but let's try IRR. Let's see. Yeah, it will be a little off.
Yeah.
There will be some rounding errors, I'm sure. But let's see if we can get it. Yeah. So what is the lower rate here, guys? 11%.
11%, yeah.
Plus NPV of the lower rate, NL, that is
104.57.
157. Okay, can I round it up to 105? Anyway, there is so much rounding. Yes.
Yeah.
105. Yeah. And then 105 minus, we will take
17.
17.3 as 17. Good.
Yeah.
Then multiplied by H minus L, that is higher rate minus lower rate. How much is that?
115 minus 11.
15 minus 11. Yeah. So then tell me now, what are you guys getting? What are you guys getting? 11 plus 105 minus, 105 minus 17 is how much, guys? It is 15, 90, 88. Is it? 105 divided by 88.
Yes, 88.
1.1931 something, right? Multiplied by 4 anyway. That is 4.772, something like that. Is that right?
Yeah, 15.7.
15.772.
I took 4.82. Yeah, put that out. Right. 15.8%.
Right.
Roughly 16%. Can I say that? Or if you want to be safe, since this is IRR, take
Yeah.
15%. What do you think? If you're using this for some practical purpose, why? Always estimate IRR
Yeah.
to be lower.
Yeah.
That's why. Yeah. Purvi, what do you think? I hope you also got this. Yeah. You guys, yes. Rajiv, anyway, you're clear, right?
Yeah.
Okay. This is something that we already did, nothing new here. Yeah. Right. So coming back to the calculations and the slides, you guys can see it here. There you go, the present values, like how we calculated. They have taken the investments later on. Sure, they haven't shown year 0 as well. Why? Probably due to a lack of constraint. Lack of space here, constraint of space here. But otherwise, you can show it, no worries. Yeah. Now, moving on from that, see what they've done for the next case. They have taken 17%. Why? Because they only set the question, so they know what percentage would work. We took 15%. Yeah. We still got the right answer. Not bad. What do you guys think?
Yeah.
So there you go.